In 1967, a quiet man from Omaha, Nebraska walked into a small insurance company and made a decision that almost nobody understood. He didn't buy a factory. He didn't buy farmland. He didn't buy gold. He bought something far stranger. He bought promises. Not machines. Not buildings. Not products. Just pieces of paper that said, if something bad happens to you, we'll pay you. At the time, many investors thought it was one of the strangest moves of Warren Buffett's career. Why would one of America's smartest investors pour millions of dollars into a business built around car crashes, house fires, and accidents? Insurance wasn't exciting. It wasn't glamorous. And it certainly wasn't the kind of industry people expected to create one of the greatest fortunes in modern history. But Buffett wasn't buying insurance. He was buying something almost nobody else could see. And that invisible asset would quietly become one of the most powerful wealth-building machines ever created. The strange part? Most people still don't understand it today. Because the real product wasn't insurance at all. It was time. Time between collecting money and giving it back. That tiny gap would eventually help finance investments in companies like Coca-Cola, American Express, Apple, and dozens of other businesses that transformed Berkshire Hathaway into one of the most valuable companies on earth. All because of one idea hiding in plain sight. Before we uncover exactly how it worked, take a second and ask yourself something. If someone handed you billions of dollars today, money you were allowed to invest, knowing you might not have to return most of it for years, what would you do? Because that's exactly the question Buffett answered better than almost anyone in history. And the answer changed everything. If stories like this make you see money differently, take a second to hit the like button. It tells YouTube that you're enjoying this kind of documentary, and it helps more people discover the channel. Now, let's go back to where the story really begins. Most people think insurance companies make money by selling policies. That's only half the story. In reality, they sell something far more valuable than insurance. They sell certainty. A parent buys life insurance hoping their family never needs it. A driver pays for car insurance hoping they never have an accident. A homeowner buys protection hoping their house never catches fire. Think about how unusual that is. Millions of people willingly pay for something while secretly hoping they never have to use it. Almost no other business in the world works that way. And that's exactly what caught Buffett's attention. Because he wasn't looking at the policies. He was looking at the money. Every single day, millions of dollars flowed into insurance companies through premiums. But those claims wouldn't all be paid tomorrow. Some will be paid months later, others years later. Some policies would never require a payout at all, which raised an unusual question. Where does all that money sit? While everyone waits, most people never even think about it. Buffett couldn't stop thinking about it. And when he finally discovered the answer, he realized he wasn't looking at an insurance company anymore. He was looking at one of the greatest financial engines ever invented. That hidden engine had a name. Float. And understanding that single word would completely change the way Buffett built wealth for the next half-century. But Buffett didn't discover float overnight. The truth is, he had been preparing for this moment almost his entire life. Long before Wall Street knew his name, before Berkshire Hathaway, before billions of dollars. There was simply a curious little boy growing up in Omaha during the Great Depression. While most children spent their afternoons playing baseball or riding bicycles, Warren Buffett was fascinated by numbers. Not because they were exciting, because they told stories. Stories about how money moved, how businesses grew, and why some people quietly became wealthy while others spent their entire lives working just as hard without ever getting ahead. By the age of 6, he was already selling packs of chewing gum door to door. A few years later, he was delivering newspapers before sunrise. He sold used golf balls, collected bottle caps, bought pinball machines, and placed them in local barbershops. To most people, these looked like ordinary childhood jobs. Buffett saw something completely different. Every dollar he earned had one purpose, not to be spent, but to start producing another dollar. Even as a teenager, he wasn't obsessed with becoming rich. He was obsessed with something much more powerful. He wanted money that could work. While he slept, that single obsession would quietly shape every major decision he made for the next 70 years. As Buffett grew older, That curiosity led him to one man who would change his life forever. Benjamin Graham, often called the father of value investing. Graham taught his students a simple but revolutionary idea. The stock market isn't there to tell you what something is worth. It's there to offer prices. And sometimes, those prices are completely wrong. Most investors chased exciting companies. Graham searched for overlooked ones. Most investors followed emotions. Graham followed mathematics. Buffett absorbed every lesson. But after years of investing, he began noticing a problem that even Graham's approach couldn't solve. Finding great investments was only half the battle. The bigger question was, where do you get more capital? Most investors had only three choices: save more money, borrow money, or convince someone else to invest with them. Each option had limits. Saving took years. Loans came with interest. Outside investors expected returns and could leave whenever they wanted. Buffett wanted something different. He wanted permanent capital, money that stayed available year after year, without constantly asking permission to use it. And then, he looked at the insurance business again. This time, he wasn't looking at the policies. He wasn't looking at the profits. He wasn't even looking at the company itself. He was looking at what happened after every customer paid their premium. Imagine this. 10 million people each pay a small amount of money today. Only a tiny percentage of them will actually need that money back this month. Some won't need it for years. Some never will, which means an enormous pool of cash simply sits there, waiting. Most people saw idle money. Buffett saw opportunity. He realized that if an insurance company was disciplined enough, if it priced risk correctly and avoided reckless decisions, that pool of cash could become something extraordinary. Not free money, not magic, but patient money. Money that could be invested while time quietly did the heavy lifting. Buffett gave that pool of money a simple name: float. It sounds ordinary, almost boring, but that single word would become one of the greatest competitive advantages in business history. Of course, there was a catch, a very dangerous catch. Float only works as long as people trust you. The moment an insurance company becomes careless, underestimates risk, or promises more than it can deliver, that same float can disappear almost overnight. One devastating hurricane, one wave of lawsuits, one catastrophic mistake, years of careful compounding, gone. Most executives looked at float and saw easy money. Buffett looked at it differently. He saw borrowed trust, and borrowed trust had to be protected at all costs. That mindset separated him from almost everyone else in the industry. While competitors rushed to sell more policies, Buffett was perfectly willing to walk away from bad business. He would rather earn nothing than risk destroying the engine that made everything else possible. That patience confused many investors, but it would soon reward him in a way almost nobody expected. Because in 1967, Buffett finally found the company that would allow him to put this philosophy into action. Its name was National Indemnity, and buying it wasn't the end of the story. It was only the beginning. National Indemnity gave Buffett exactly what he had been searching for. Not another business, not another stock, a financial engine. Every day, new insurance premiums flowed into the company. Every day, the float quietly grew larger. Most CEOs would have looked at that growing mountain of cash and asked one question: how much can we spend? Buffett asked a completely different question: how long can we keep it? That single difference changed everything. Because Buffett understood something that many executives never did. Float wasn't income. It wasn't profit. And it certainly wasn't free money. It belonged to someone else. He was simply being trusted to hold it. That meant one careless decision, 1 year of reckless underwriting, or one major catastrophe could destroy decades of disciplined investing. Buffett often compared insurance to building a dam. A dam can generate enormous power, but only if every crack is repaired before it becomes a flood. Ignore one small weakness, and the entire structure can collapse. That's why Buffett became almost obsessive about risk. He refused to chase growth just because everyone else was doing it. He walked away from policies that looked profitable. He rejected customers other insurers were eager to accept. At first, Many people thought he was making a mistake. Competitors were growing faster, writing more policies, reporting higher revenues. Wall Street loves growth, even when that growth hides dangerous risks. Buffett loved something different: survival, because he knew one simple truth. A business that survives for 50 years will almost always beat a business that grows quickly for 5. And then, the biggest test of that philosophy arrived. The year was 1976. GEICO, one of America's fastest-growing insurance companies, was collapsing. Just a few years earlier, investors had celebrated its explosive growth. Now, the headlines told a very different story. Losses were spiraling. Claims were overwhelming the business. Confidence disappeared almost overnight. The company's stock had crashed by more than 90%. Many analysts believed bankruptcy wasn't just possible. It was inevitable. Investors rushed for the exits. Financial newspapers questioned whether GEICO would even survive. To almost everyone, it looked like a sinking ship. But Buffett wasn't looking at the headlines. He was looking beneath them. He knew GEICO better than almost anyone. Years earlier, as a young student, he had spent hours studying the company and its business model. His belief in the business had never disappeared. Only the management had failed. And those were two very different problems. Most investors saw a broken company. Buffett saw a broken system that could be repaired. If disciplined leadership returned, if underwriting improved, if trust could be rebuilt, the float would survive. And if the float survived, the business could survive too. It was one of the boldest decisions of his career. If he was wrong, millions of dollars would disappear. His reputation would suffer. Years of disciplined investing could be undone by a single mistake. But if he was right, he wouldn't just own another insurance company. He would control one of the most powerful sources of investment capital in the world. History tells us how that decision ended. GEICO recovered. Slowly, painfully, but steadily, and as the company regained its strength, its float began growing again. That growing river of capital didn't stay inside the insurance business. Buffett quietly redirected it into extraordinary companies. Businesses with products people used every single day. Coca-Cola, American Express, The Washington Post. Later, Apple. Businesses that generated cash, year after year, while the float continued doing exactly what it had always done, growing quietly in the background. Without that invisible river of insurance money, many of Berkshire Hathaway's greatest investments might never have happened. And that's the part most people miss. When people look at Buffett's fortune, they usually focus on the stocks. Very few stop to ask the far more important question: where did the money come from in the first place? The answer wasn't a lottery ticket. It wasn't leverage. It wasn't speculation. It was trust. Millions of ordinary people paying insurance premiums, never realizing they were helping fuel one of the greatest investment machines in financial history. And that realization changes the entire story. Because Buffett didn't become one of the richest investors in the world simply by picking great companies. He first built the engine that allowed him to keep buying them. By now, Buffett had done something extraordinary. He had taken one of the oldest businesses in America and quietly transformed it into one of the greatest investing machines the world had ever seen. But here's the part that matters far more than Buffett himself. Because this story isn't really about insurance. It's about how humans assign value. For thousands of years, people believed wealth came from things they could see: land, gold, factories, oil, buildings, things you could point to and say, that's valuable. But over the last century, the world's biggest fortunes have increasingly been built on something far less visible: trust. Think about it. Netflix doesn't sell DVDs anymore. It sells access. Spotify doesn't sell CDs. It sells convenience. Adobe stopped selling software in boxes years ago. Now it sells subscriptions. Even Apple, one of the most valuable companies in history, earns billions from services that customers renew month after month without ever holding a physical product in their hands. The products changed, but the psychology never did. People don't just pay for objects. They pay for certainty, for convenience, for reputation, for peace of mind. Exactly the same forces that made insurance valuable decades earlier. And that's why Buffett's story still matters today. He wasn't chasing trends. He wasn't predicting the future. He simply understood something timeless. If people trust you enough to pay before they receive value, you've created something incredibly powerful. Not because you've discovered free money, but because you've earned time. Time to invest. Time to improve. Time to compound. Most people spend their entire lives searching for the perfect investment. Buffett spent his life building the engine that made investing easier. That's a completely different way of thinking. And maybe that's the lesson hiding beneath this entire story. Most people ask, what should I invest in? Very few ask, what system can I build that keeps creating opportunities to invest? That single shift in thinking separates people who occasionally make money from people who quietly build wealth for decades. But there's another lesson, one that's even more important. Float only existed because people trusted the promise behind it. The moment that trust disappears, the engine stops. The same is true for every great business. A bank without trust is just a building. A brand without trust is just a logo. A business without trust is just another company competing on price. Trust isn't soft. Trust is economic value. It's measurable. It's profitable. And when protected carefully, it compounds just like money. Maybe that's why Buffett never described Berkshire Hathaway as a collection of stocks. He described it as a collection of wonderful businesses run by people he trusted. Because in the end, his greatest investment wasn't Coca-Cola, or American Express, or Apple. It was trust itself. The kind of trust that quietly attracts customers, creates opportunities, and survives long after trends disappear. So the next time someone tells you that only physical things have real value, remember the quiet investor from Omaha, the man who looked at a stack of insurance contracts and saw one of the greatest financial engines ever created. He didn't build his fortune by chasing what everyone else could see. He built it by recognizing the invisible forces everyone else ignored. And maybe that's the biggest advantage any investor can ever have. Not seeing more than other people, but seeing differently. If this story changed the way you think about money, share it with someone who believes wealth only comes from working harder. Because sometimes, the most valuable assets in the world are the ones you can't hold in your hands. And if you enjoy documentaries that uncover the hidden ideas behind history, business, and wealth, subscribe to Money Elevate. Because the next story might completely change the way you look at money all over again.